Hello, and welcome to this lecture on the federal funds market. I hope you're doing well from wherever it is you're joining us. In this class, we will discuss the background and workings of the federal funds market. We will proceed in two steps. First, we will examine why banks hold reserves at the Federal Reserve. We will distinguish between required reserves and excess reserves. Second, we will study the federal funds market. In this market, banks borrow and lend excess reserves amongst themselves. We will see how this is a crucial overnight lending market. Let's first understand what reserves are and why banks hold them. The business model of a bank is to borrow short and lend long. Banks take on-demand deposits. They use these funds to make loans. This business model creates demand for cash, also known as liquidity, at the bank. For example, deposits can be withdrawn at any time. So the banks need to have a certain amount of cash on hand that can be used to meet liquidity needs. This cash can be held in a reserve account at the Federal Reserve. How much reserves should a bank choose to hold? This is a difficult question. In the United States, banks are legally required to hold a minimum amount of reserves at the Federal Reserve. These are called required reserves. This reserve requirement is set at a level to ensure that banks can meet their day-to-day cash needs. This level is decided by the Federal Reserve. Before the COVID-19 pandemic, the reserve requirement was 3% of deposits. To support banks during the COVID-19 pandemic, this requirement was set to 0. Those are legal requirements. Banks usually hold more reserves than what is required. These are called excess reserves. Banks hold these excess reserves to meet unknown liquidity needs. For example, early in the COVID-19 pandemic, US corporations drew down about $600 billion from their credit lines. Banks could not plan for this unforeseeable event. Nevertheless, banks had to provide $600 billion of cash to their customers on short notice. Hence, the need for excess reserves. How do banks choose their level of reserves? Banks can either hold cash in form of reserves or they can invest this cash. For example, they could invest in loans that earn the bank interest income. What are the trade-offs? Holding reserves typically generates lower income as compared with loans. However, if a bank faces an unforeseen liquidity need, it may have to borrow at the last minute. This can be costly. So, banks face a trade-off between their liquidity needs and lost earnings if they had invested in interest-paying assets. These lost earnings are called the opportunity cost of holding excess reserves. Here are the data on reserve holdings of US commercial banks. Historically, reserves were low. As you can see, reserves barely increased between the 1960s and 2007. However, since the 2008 financial crisis, reserves have increased significantly. Reserves increased from about 40 billion in 2007 to almost 3 trillion in 2014. They further increased to 3.7 trillion in March 2021. Why has there been a sharp increase in reserves since 2008? First, low interest rates between 2008 and 2022 reduced the return on interest-paying assets such as loans. Second, the Federal Reserve started to pay interest on reserves. These first two factors lowered the opportunity costs of excess reserves. Third, banks experienced large cash demands during the financial crisis. The surviving banks decided to hold larger reserves going forward as a safeguard. Now, let's look at the federal funds market. What happens when a bank does not have enough reserves to cover its liquidity needs? The bank can borrow reserves from other banks. This takes place in the federal funds market. Loans in the federal funds market are usually overnight and do not require collateral. This means that this market requires a lot of confidence that the bank will not fail. The cost of borrowing in this market is called the federal funds rate. The federal funds market is a so-called money market. That is, it provides cash overnight. Why is the federal funds market so important? I want to emphasize two key functions. First, the federal funds market reallocates funds between banks. Some banks have a lot of lending opportunities but little cash. Other banks have a lot of cash in forms of reserves but few lending opportunities. Through the federal funds market, the second bank can lend the first bank cash. This allows the first bank to meet their loan demand. The second important function is that the interest rate for federal funds, the federal funds rate, influences the cost of credit in the economy. Banks decide whether to hold reserves or to grant loans, such as mortgages. If the federal funds rate is high enough, then banks must receive high interest on, say, new mortgages. Otherwise, the bank can just hold reserves and lend them out in the federal funds market. Thus, the federal funds rate might affect the cost of mortgages. The same logic holds for all other assets, not just mortgages. Interest rates across all markets are linked to the federal funds rate. However, there will be a stronger effect on shorter maturity assets. Short maturity assets are the closest substitutes to the federal funds market. These substitute overnight cash markets will be immediately affected by a change in the federal funds rate. Later in this course, we will see that the Central Bank of the United States, the Federal Reserve, controls the federal funds rate to achieve its policy goals. The Federal Reserve does this by controlling the supply of reserves in the federal funds market. These are called open market operations. What have we learned in this lesson? First, banks hold reserves because they are required to do so by law. Second, banks hold additional excess reserves to meet unforeseen liquidity needs. Third, the federal funds market reallocates cash across the banking system. Fourth, the interest rate for federal funds influences all other interest rates.